Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. As we start out 22, it's important to look back at the year that was and use that to help us understand what the markets hold for us in the coming year. So here to help us is Chartered Financial Analyst and the head of our investment committee, Jerry Herman. So Jerry, what's some of the highlights from last year?
Well, last year the world returned to some level of normalcy, and it resulted in a recovering economy. Even though there were challenges, we had variants with the virus, we had disruptions in the supply chain, we had the highest level of inflation in decades. Massive fiscal and monetary stimulus coupled or combined with the vaccine rollout, as well as pent-up consumer demand, drove the economy. GDP was actually up 5.7% last year, the highest level in a quarter of a century.
And there were some other bright spots as well. Household finances emerged from the crisis and spending on big-ticket items surged. Unemployment declined from 6.7% at the beginning of the year to less than 4% at the end of the year, with increasing signs of labor market tightness.
Yeah, and overall, equity investors benefited from this combination. Last year, the S&P 500 hit 70 new highs. That's the most there's been since the mid-1990s. The S&P was up 27% last year. The third year in a row, it actually increased more than 18%. It's only done that 3 times in history. So while the equity markets were strong, the bond markets were actually weak. One of the worst years on records where interest income was actually offset by bond price declines.
So what can we expect for 22?
Well, we're starting off with a very volatile condition, but there's a couple of key themes. Central banks around the world should ease or pull back on monetary policy. We expect the Fed to increase interest rates, even maintaining some greater tolerance to inflation. But we think investors should expect a more volatile environment as the market anticipates and reacts to the Fed.
So inflation could very well settle in at higher levels than pre-pandemic, even as supply chain bottlenecks ease, and rates also are heading higher. So another consideration for 22 would include things like potential new virus strains, midterm elections, and also geopolitical risk.
That's right. Bottom line for 2022, there's still a preference for equities given the inflationary backdrop and a growing economy. And while there's no guarantees, when the market delivers 18% plus for 3 straight years, it tends to follow up on a fourth. Now, I think investors should expect more moderate returns with greater volatility in equities and another tough year in the bond market.
So with a combination of a strong economy, interest rates expected to head higher, and inflation above normal, we could see an impact on certain equity styles and sectors.
Yeah, we encourage investors to take a very good look at their portfolio, to review their allocations, make sure they're aligned with goals, risks, and objectives. Look at allocations, diversification, look at style, sector, and geographic opportunities and the role of fixed income in the portfolio.
Well, great. Thanks again for joining us, Jerry, and helping us to explain the look ahead in 22. If you're concerned about rising interest rates, inflation, and other changes that may be ahead for 22, give us a call. We're here to help.